when it comes to earning passive income from stock investments. Few strategies are as time-tested and beginner-friendly as the covered call. This strategy blends the safety of stock ownership with the income-generating potential of options, making it a favorite among conservative investors, retirees, and even seasoned traders looking to maximize returns in sideways markets. At its core, a covered call is simple. You buy or already own a stock, and then sell a call option on that same stock. The call option gives the buyer the right, but not the obligation to purchase the stock from you at a specified strike price before the expiration date. In return, you receive a premium cash from the option buyer, whether the stock goes up, down, or sideways. That premium is yours to keep. This strategy is best suited for markets that are neutral to slightly bullish. If the stock does not move much or moves just a little upward, you profit from the premium received without losing the stock. Even if the stock declines slightly, the premium acts as a buffer, reducing your effective loss. Let's take a classic example. Suppose you own 100 shares of Apple, currently trading at $180. You sell a 1-month call option with a strike price of $190 for $3 premium per share. That is $300 in your pocket immediately. If Apple stays below $190 by expiration, you keep the shares and the $300. If it rises above $190, you are called away, but you still make a profit. $10 per share from stock appreciation, plus $3 from the premium. One of the biggest advantages of this strategy is its predictability, unlike pure stock speculation or risky trades. The covered call gives you a clear picture of your maximum profit and maximum loss. Your upside is capped. If the stock soars, you must sell it at the strike price, but your downside is partially protected by the premium received. Another benefit is how it reduces volatility in your portfolio. The consistent income from premiums can smooth out returns, especially in flat or choppy markets. For long-term investors who plan to hold blue-chip stocks anyway, it is a way to generate cash flow while waiting. This strategy also enhances returns on stocks that might be slow movers. For example, utilities and dividend stocks are typically stable but do not offer explosive growth. Covered calls on these stocks can double or even triple annual returns through monthly or quarterly premium income. Let's look at a real-world success story. A retired school teacher named Linda from Ohio, with a $500,000 stock portfolio, began selling covered calls on her holdings in companies like Johnson & Johnson and Coca-Cola. By selling options monthly, she generated an extra $20,000 per year, covering her living expenses without touching the principal. For Linda, it turned into a reliable income stream safer than chasing high-yield but risky assets. Another famous example is the buy-right strategy used by many institutional funds. Some ETFs, like the Global X Nasdaq 100 Covered Call ETF, or JP Morgan Equity Premium Income, use this exact strategy to pay monthly income to investors. These funds manage billions and cater to income-focused investors, retirees, and conservative traders. But every strategy has risks. In the covered call, the main risk is missing out on big gains. If your stock jumps 20% and your strike was only 5% higher, you are forced to sell it at that lower price. Also, if the stock falls sharply, your losses are not eliminated, just slightly reduced by the premium. So, it is important to choose solid, stable stocks and realistic strike prices. Some traders use rolling strategies, closing one call option early and selling a new one at a different strike or expiration to adapt to market movements. This adds flexibility and lets you stay in control of your stock holdings. Timing matters too. Selling options when implied volatility is high, like before earnings, results in higher premiums, meaning more income, but it also increases the chance of being called away. So traders need to balance risk and reward. Many platforms now offer automated covered call writing, making it easier for everyday investors. Some brokers even allow you to set up recurring covered calls, simplifying the strategy and removing emotional decisions. In conclusion, the covered call strategy is a smart, steady way to earn income from your stock portfolio. It does not promise wild profits, but it offers consistent returns, low risk, and peace of mind, making it one of the best entry points for anyone starting in options trading or seeking dependable cash flow. Thanks for watching. If you found this video helpful and want to learn more low-risk strategies to grow your income and master the market, do not forget to like, share, and subscribe to West is Best. Your support helps us bring you more smart investing tips, success stories, and powerful strategies every week. See you in the next video.